Howard Marks just came out and said there's going to be a big sea change. What he means by that is there's going to be a big difference in the landscape of investing. And we're going to get into why he's saying this because he's only seen two previously different sea changes in his lifetime at 53 years of investing. To pandemics, to bubbles, to crashes, everything. He's dealt with everything and he's seen two sea changes. And now he's saying there's going to be a big third one coming up right now. And we have to understand this because if he is right on this is going to be a big change in our investment strategy, or we're going to have to do something different or kind of just think about it differently, because you have to remember in the history of the stock market, there's been crazy things happening and people keep thinking stocks always go up, they never go down, they just stay consistently up. But if you know the history of the stock market, that is not true. There's been crazy amounts of movements in the stock market where there's been zero gain in 20 plus years. So if we had a 13-year bull market and we're coming off that, do you really think there's going to be another 13 plus year bull market? So we have to keep that in mind when we're thinking about the investment future. There is a likely chance where the market doesn't go anywhere for 10 plus years, maybe even 20 plus years, because it's happened so many times in the history of the stock market. The last episode of Invested, Phil Town actually goes through this. Daniel Town, his daughter, asks Phil Town, is there a time period where stocks is a bad investment? And he says, yes, there's been so many time periods where stocks were a bad investment, and he goes through this. If you bought the whole market index between 1965 to 1983, the return of the whole market was zero. From 1929 to 1956, the rate of return of the whole market was zero. From 1903 to 1921, the rate of return of the whole market was zero. There's been a lot of periods in time where the market has gone nowhere. So do you believe that that can happen into the future? Of course that can. So you have to find what's going to work in those time periods where the market goes nowhere, and you have to be prepared for that. So we're going to get into that right now, but let's go into what Howard Marks was saying about the two big sea changes before this third one coming up. The first big sea change came when a lot of industries and a lot of firms looked at risk and return. But before that, they didn't look at that because they were afraid to invest in any type of bonds that seemed kind of risky. And they didn't look at the return factor that you can make money on risky bets if they provide a great return. So that mindset wasn't into Wall Street at that time. And actually, Howard Marks took huge advantage of that, investing in these kind of risky bets, but they provided a good return. And that was a big sea change from what was there before, because Wall Street would not invest in those risky type of assets. However, the most important aspect of this change didn't relate to high yield bonds or to private equity, but rather to the adoption of a new investor mentality. And now risk wasn't necessarily avoided, but rather considered relative to return, hopefully born intelligently. The new risk-return mindset was critical in the development of many new types of investments such as distressed debt, mortgage-backed securities, structured credit, and private lending, etc. That was the first big sea change that Howard Marks saw. The next sea change that happened in the market in the macro world is when the OPEC embargo happened, when oil came from $24 and shot up in less than a year to $65, which caused a lot of inflation during the 1973-1974. And with all the consumer price index going up, shooting past 11%, Paul Volcker, the Fed chairman, had to kill that whole inflation. He went up all the way up to 20% Fed fund rate just to cancel inflation and shoot it back down. And with this all happening, and with the next sea change coming up, because with that, this made forth the next government to come in and kind of lower interest rates, slowly kind of get the market to kind of pick up again. And over the 40 plus years, interest rates have been going down, with inflation not going up as well, kind of remaining as steady as possible. The last 40 years was all about lowering of interest rates and kind of stimulating the economy. An incredible tailwind. What are the factors that gave rise to investors' success over the last 40 years? We saw major contributions from economic growth, preeminence of the US by the incredible performance of our greatest companies, gains in technology, productivity, management techniques, and the benefits of globalization. However, I'd be surprised if 40 years of declining interest rates didn't play the greatest role of all. So what Howard Marks is saying, that the Fed was just increasingly just lowering interest rates, providing a lot of liquidity into the markets, buying bonds, buying stocks, just giving all that money into the market. People were actually able to borrow at these low prices, borrowing money, buying all these assets, but that is no more. The Fed is going to continually have these rates at higher rates, not 1%, not almost 0% anymore, probably closer to 4 to 5%. So what is that going to do for the economy moving forward? As maybe you don't have to look to assets or look to stocks to get these returns. You can look more to bonds, and you don't have to invest in riskier assets, stocks, in his opinion. What's going to happen to the market in the next 40 years? We may never see interest rates at all-time lows again, but what happens with normal interest rates maybe above 3% to 4 to 5%? What is that going to do for stocks into the future? And Howard Marks goes into this. We've gone from the low return world of 2009 to 2001 to a full return world. It may become more so in the near term. Investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely heavily on riskier investments to achieve their overall return targets, aka stocks. Lenders and bargain hunters face much better prospects in this changed environment than they did in 2009, 2001. And importantly, if you grant that the environment is and may continue to be very different from what it was over the last 13 years, most of the last 40 years, it should follow that the investment strategies that work the best over those periods may not be the ones to outperform in years ahead. That's the sea change I'm talking about. He's coming out and saying that the investment strategies that people were using 13, 20 years ago might not be the same going forward. So what should you do knowing that the market can give you a 0% return over the next 20 years easily? After a 13-year plus bull market, it can easily do that. So what should you do? So what investment strategy should you use knowing that this could potentially happen? You still have to use the same old strategies of investing in companies that are undervalued. And what Phil Town was saying is that you invest in companies that are undervalued. When they get to intrinsic value, you sell off. During those times in the 1960s where the market went nowhere, the Dow went from 1,000 back to 600, back up to 1,000, down to 700. So during those times, in those middle of those spreads, you can make money. And that's all about buying companies below intrinsic value, selling them at intrinsic value, below intrinsic value, selling them above intrinsic value. So that might be the strategy that you might have to be using going forward. But it's still the same process. You're buying undervalued companies, waiting till they reach intrinsic value, and you're still holding them. So guys, you're still using the same value investing strategies going forward, but you have to make sure that the companies can survive. They have strong balance sheets, strong management, the revenue is still growing, the earnings are still growing, they have good capital allocators. So the same strategies you were using in the past, you're going to be using for the future in these hard times that might come up. Guys, if you liked this video, like it, subscribe to my channel, and I'll get back to you in the next video.